Good afternoon, everybody. My name is Chris Swift. I'd like to welcome you to this webinar on behalf of my partner, Chris Windward, and our sales assistant, Sean Gammon. Thank y'all for attending this. So today we're going to discuss the aspects of the feeder cattle index because it is least involved in either algorithmic computer trading or any of the commodity funds, any of the outside market forces. It just tends to be what cattlemen are doing. We're going to discuss the feed costs and some of the financial stresses that are coming about with some of our cattle producers these days. So the one thing that we want to start with is I do not know what will happen over the summer, but I do know what can happen. And we're going to start this out with the drought that is upon us. This is last week's drought monitor on here. And although the Corn Belt is not specifically as involved in it this week, when I change the charts, note how much more dramatic to the eastern portion, the northern eastern portion of the belt that becomes impacted. So I drew a circle around there, and I'm going to toggle back and forth for just a second between two charts. So here you can see this is the majority of corn planted acres that we have here in the U.S. And I have attempted to kind of outline that in the drought area. So we notice that Illinois and Indiana have now become in the yellow. Michigan has become solid brown. Greater portions of North and South Dakota, and now even greater in Nebraska. We do understand that a lot of the corn in Texas and in South Kansas is all irrigated, but some of it is not. Some of it is still dry land. So these differences where this corn is primarily grown seems to be encroaching further in the drought area. So I looked at this is today's 30 and 90-day forecast. And if you look at the moisture, the temperature is not as significant as it is to the temperature. So when we look at the 30 days, we see the eastern portion of the Corn Belt still in a relatively wet pattern. But as we move down to the 90-day, everything east of Oklahoma, Kansas, Nebraska turns off drier, and the moisture pattern begins to shift east even further. So this to me looks like that although we may not be in a severe drought is definitely going to impact us. And when we consider where it is in the northern tier areas where we grow a lot of the cattle in these areas right here, we are really deficient on pastures and the ability to hold those cattle. Today, I got a little information from the Daily Livestock Review that stated that the herd expansion was just right about where it has been. We had seen a decrease in heifer placement over the last several quarters, and we had seen a decrease in the cow kill. As of the fourth quarter of 20 and the first quarter of 21, the cow kill had increased, and the heifer placement, as we saw on last Friday's Cattle on Feed report, had gone down, had risen just a little bit from 37% to 38%. So one issue that is probably pertaining to this drought, is this drought. So we're starting to move more cows off of the pasture. We're moving more heifers into the kill slot now. So between the financial issues that some have and this drought, it is really perplexing how we're going to go through the rest of this summer, believing that at bare minimum, the drought kind of stays where it is or maybe intensifies just a little bit from the 30 and 60-day weather forecasts that we see. So again, I'll leave that on there for just a second to take a look at that, where the moisture differs greatly here on the 30-day versus here on the 60-day. And we can see this brown line, how now it encroaches all of Nebraska, Kansas, Oklahoma, and Texas. And I know that rainstorm that came through today helped out tremendously in some of these areas, but honestly, it wasn't really all that much moisture that we got to it. So we'll take a look at the weekly feeder cattle index. And as we can see, this is the determination of what cattle feeders are willing to pay for the feeder cattle. This is the COVID low right here, the April of 20 COVID low. Here is where all of the speculation begins, and my analysis seems to believe that this one particular move right here is a wave one rally. So I'll put it on this is the same chart. I just got my Elliott Wave count on here. I can count 5 waves up to this high. And from this point, and this is August of 20 is when this high is right here. Now we just start trading sideways ever since that point time frame in there, and we haven't been able to break out of it yet. So with this, it leads us to two different aspects that might take place. So here's a daily of it. We're going to condense it down from a weekly chart to a daily chart, and we can clearly see the stagnation from August, September of 20 to present. And it's been pretty volatile, been trading right around between 133 and 144, an $11 price range. Now we're back deep into that price range again, and the drought begins to depict which direction the market moves next. So in my primary wave count, the one that I have been believing is probably the most accurate to date is this right here, showing the wave one complete, a complex correction to the April of 21 low, and then this rally initially being a wave one rally. The wave two, I can already tell you, is getting very close to exceeding this, and that is 133.86 is that lowest point. If this price on this decline exceeds that, I will have to then change my wave count to this. That extends the correction that we're in further. It suggests that the drought has probably intensified due to people having to sell more feeder cattle at a time frame when it is believed that after the first half of the year, we may actually find ourselves with a few fewer head of inventory and feeder cattle to work with as we have before. So the drought's going to play probably the most specific part of what we're going to look for the remainder of this year. So again, if we take out 133.86, now we begin to move lower. And what I believe you'll see is a C wave decline. That C wave decline then could either stay that way, end up around 127 to 125. We get through the middle of the year and the drought either A, subsides, or another fundamental aspect picks up. Maybe corn prices go down. Something, though, might begin to change ever so slightly to begin pushing that market up to a wave three. At the very onset, we have got tremendous number of cattle to still have to work through in the feed yards. We have a very financially stressed cattle producer that is not going to be able to come back very strongly, as well as we still don't know what corn's going to do. So we go down to the next, and we see this one, thanks to Craig Purvines and the cattle range there. This was last Friday's or Saturday's, I think, last Saturday's chart of this. Now showing the price of corn has exceeded all of these factors, the feeder cattle and the feeder steers. And the charts that he shows previously, although we've seen them come close together, this is the first time we've ever exceeded it. So I think this is a good depiction of how much financial trouble the cattle feeder is in, seeing this abrupt move of the corn prices and literally no movement at all to the downside for feeder cattle prices as of yet. So we're going to talk about the corn because this is what brings us into the drought. It's a combination of the drought and high corn prices. And I am pretty sure that this is the sharpest increase in both time and price, short length of price and shortest period of time that we've seen. Even this area right here and this area right here are not quite as short a time frame as what this one is in the price movement. Interestingly enough, that we can go back and look at that feeder cattle index all through 14 through 19, and we can see that at the bottom of 15, cattle feeders have dealt with under $4 corn prices for the majority of the time frame in there. Now we're dealing with $7 corn prices, and if we look and go back and look at the feeder cattle index again, we see here's we'll go back to the weekly. So here we go back to the 15-16 time frame, 15 being the top end of it. Corn had not traded much of anything during this entire time frame that feeder cattle stayed right in about the same price. Now corn has gone up significantly, and the price of feeder cattle has still not come down any. So I think that's a big question. Do we, again, go back to the drought aspect of it and to the wave count here, where the alternative wave count, do we go into 125, stall there, drought subsides, corn subsides, something happens, maybe we get the packer to be able to facilitate a larger kill and begin to open some of that discrepancies up where we can't be able to kill as many cattle. The alternative to even this one, though, is to take out that April of 20 low. It is possible if the drought intensifies to a level greater than what we think it will right now. Right now, it stays dry. We've already seen some producers move to circumvent that drought. If it continues, we just know that that's going to keep going for until it subsides. And from the 2013 and 14, excuse me, 2012 through 13 timeframes, we know those droughts can persist for over 2 years. Back to the corn again here. So as best as I can tell, this being a runaway market, there's really no way to depict of what it will do, but we do know what it can do. And we know that it can go to $8.47 a bushel because it's been there before. And we also know that from lumber prices and other commodity prices that we could see enormous price swings that we could never even fathom to imagine. So we have a lot of work cut out for us this year in trying to figure out what can happen. We know we have a drought in front of us. We don't know the severity of it. We know what impacts that droughts can have on grains and livestock grazing. So it's a time to be prepared. It's not a time to go in and start laxing and say, well, corn will go down after it gets in the ground, and then we'll see the rains come and it'll improve the pastures. And it might. But if it doesn't, and if it does do that, then everything's going to be better. We'll see greater pasture. We'll see the cattlemen be able to hold more cattle on their ranch. We'll see feed costs come down, but it might not. And that's what we're most concerned with, is that it might not, more so than it does. So this is a daily of July corn. We know that May is carrying about a 50-cent premium to it right now. You got 4 more weeks of May to trade. There's not, to the best of my knowledge, any corn being grown across the world right now that would be deliverable to the export markets within the next 60 days. So once May goes off the board, we're probably not going to see any world corn production that could go out for export until you get this year's U.S. corn crop out of the ground. That makes for very tight supplies. And if we look at the oscillator reading on the daily chart, we already see that we have the highest high in price with the highest high in the oscillator. So that tells me right there that this move is not over with. And when we narrow it down into the hourly charts that I've been trying to show and depict on where to be buyers again, today we triangulated in the corn price. And I made some recommendations today. I wanted to be back long in the market. I think that corn could probably breach over $7 in the July contract, and we just track it day in and day out as the drought continues, and or we see more and more imports come in from China. China can come in and say, we want more. We've already seen it twice in the last 2 weeks where out of the blue, they come in and make big corn purchases on there. They need corn. That's another aspect of it with our lower US dollar. Our Federal Reserve backing that 100%. As of yesterday, they told us they were not going to do anything with the $80 million a month bond buying purchase, nor the $40 billion mortgage-backed securities. So 120 billion is still going to be pumped in every single month by the Federal Reserve. The administration last night stated, we're going to put more stimulus out there. I understand that previously a lot of traders and cattlemen focused on that stimulus and on these checks that individuals are getting, unemployment checks are getting, that would boost beef demand. It might have boosted it a little bit, but the unfortunate of having too many cattle on hand and not enough packing capacity, it doesn't matter. My opinion is still the consumer is eating no more beef today than he did forever. And at the higher price, he's probably starting to eat just a little bit starting to eat just a little bit less. So we know that the Fed's going to continue to pump money into the market. We believe that will continue to help the consumer. But until it does, until we start to see fewer cattle out there where that impact can be felt, we probably have more of the same. With that said, that money coming in is probably some of it being used to help prop up these commodity prices. And there won't be much government interference simply because of yesterday's statement by the Fed stating, we're not concerned about inflation and we're not going to do anything about it as of yet. So with that said, I believe them. I think we're fixing to see more of the same, and that means rising goods and services costs to you, plus rising input costs that just aren't going to go away anytime soon. And we note that fuel today pumped up and touched new contract highs in the crude oil and the heating oil. So unfortunately, energy prices are still right up at the very tip top. So this shows us a little bit about the financial problem that they're in on cattle feeding. We can look back to December 4th, and there was only 1 week that cattle were profitable. These losses are just unbelievable. And when you go and you look at things like this, where the current future a week ago, a month ago, a year ago, clearly the year ago was due to the COVID issue out there, but even the 5-year average, cattle feeders are not making any money. The ones that we believe are in a vertically integrated supply chain are at least surviving. Probably the best that you could say for them right now. And with the amount of stimulus money that got paid out, the subsidies that got paid out, seemingly all the cattlemen did was put that right back into production again. Whether it created a lack of debt or increased their debt to try to expand, I'm not real sure. But what I do know is just seeing the input cost price and knowing the price of the finished cattle, we're not seeing any kind of profits in there in the cattle feeding business. So what do we do about all this? That's probably the biggest issue of what can we do here. And we look at the August contract. The May is already dead tied with the index. The index closed today at 135.07 unchanged. I have seen sales receipts coming out of the barns at the 125 to 128 area that will go into the feeder cattle index category. This leads me to believe that the feeder cattle index will most likely continue to drop from the current 135.07 level at least to 130. By this time next week, I think you will begin to see that. What I don't know, and this is what I'm hoping for, is the commodity funds and the speculators believe there might be a glimmer of hope, and they run the futures market back up to somewhere between 154 and 155 on the August contract. If they do that, I think that's an opportunity to lay off some more risk. How you do it is up to you. Of course, we're very fond of the fence option strategy trade, where we buy the at the money put, we sell an out of the money call to lessen the price of that put option premium, creating all various different risk to reward parameters. That particular trade is a 100% margin and has unlimited risk losses to it, as well as unlimited profit potentials to it above and below the 2 strike prices that you choose. If we don't get that, if this is all of the correction that we're going to see in this decline, these 4 or 5 days right here, if we start trading back up underneath this, which I'm not bad and mistaken, but I think we're right at, right at a new low close down through here. So if you start trading much up underneath these lows, we might have missed this opportunity because it didn't trade back up into here. I think if we miss this and we start down, it's telling us that the feeder cattle index is most likely going to continue to go lower. So I haven't changed this one. It's currently still at 135.07, so a little bit lower. Here's the 125 area that if you look at just the index would be an approximate 50% retracement of the increase from the April of 20 low to the August of 20 high. So there's still a long way left to go, just to get to the index of 135. Again, I've seen some numbers coming out of the sale barns this week that lead me to believe that we'll trade under 130 with maybe 125, depending upon how the drought intensifies. So I'm going to say still, until we get below these lows right here, I'm going to hold out and hope that the speculators or hedgers, or not hedgers, but speculators of the commodity funds come back in, try to boost this market back up somewhere around this previous low, wave 4 low, wave 4 high right here, and then look to make some marketings. If we don't get that chance and we start trading below here, the unfortunate is we're going to have to take our best shot. It's not going to be pretty. There is still this premium that we collect on it right now. We're still with a $13 wide premium, $13.70 premium that we have here. So let's not disregard that. Clearly, it's not as good as the $25 premium we had previously, but it is still premium versus, and if you use the fence hedge, instead of selling the futures contract, and that is where you short, you do not become short the market until the underlying futures contract breaches the short call strike price. That's when realized losses begin, and that's when you can tell yourself, well, I may have sold a little bit too early. So the next aspect is going to be the fat cattle market, and I showed this because they're both going to decline, I think, about the same. We're going to get April to go off the board tomorrow, and when it does, June's going to pick up at a $3 discount. So instantly, instead of 118.55, you're going to see 115, whatever June closed at today. So this has a 50% retracement right around 105, with this wave 4 right here at around the 110 area. So that's why I chose the 110 area to the 104. This would be the wave 4 of the most minor sequence up. This would be the wave 4 of the major sequence up. This is where I'd probably look for fat market to trade back down to. First quarter placements were heavy. They're the second highest since 1996, and we can't get beef slaughtered to begin with. If April turns out to be as big a placement month as I think it will be, and I'm not saying it's going to be huge, I'm just saying it'll be 2 to 3% over last year. Again, barring the COVID, we understand what the COVID did to the placements, but under quasi normalcy, about a 2% higher. That would give enough cattle into the feed yards to supply the packer all the way through the Labor Day weekend. We are trading the highest beef prices right now to the retail consumer. I don't know what they will suffer through. I don't know what they will, continue to increase discretionary spending to. But I know they're faced with a very high price at the moment, and I do believe that there is enough cattle inventory in place right now to meet any demand that may come with the current packing capacity. So fat cattle probably not going to perform much better. There are no premiums in the fat. We're already back to dealing with discounts again. I have to hand it to the packer. I think that was one of the smartest moves I've ever seen anybody make. 8 weeks ago, offering a $2 to $3 basis over the June board for first and second week of May. They secured the inventory during a time frame when other analysts believed that we would be the most short of cattle for the year. That's where it was going to be, and they filled that hole with no trouble whatsoever. So the packer is still working on a very highly leveraged basis. And in my opinion alone, not to be confused with fact at all, is until we get through a few of these animals, there isn't going to be any leverage afforded to the producer. I know that's harsh to say. I know it's bad. And yes, we could have a consumer that strengthens further in discretionary spending and causes more packing facilities to open and produce more beef. But the likelihood of it within the next 2 years is not very good. Then within the next year, it's not very good. So the high prices of beef may spur further processing and production of, but it's probably not going to be anytime soon to get us out of that. So I anticipate the feeder cattle market declining somewhere to around 130 to 125. I don't know if we'll get much more of a rally than what we're getting right now. If we do, I'm going to use it to the best of our benefit. If we don't, then we're going to have to make our best shots that we can. Fat cattle market, I believe there's ample plenty inventory on hand to work through the rest of the year. I don't think the packer is going to have too awful much trouble keeping the margins as wide as what he has right now, simply because box beef prices are so high. When box beef prices start to come down, then he has zero incentive to go in there and bid up for inventory because now he's losing his margins. I think there could come a time, sometime within the fall of the year, that cattle producers have come to one of two conclusions. We're either going to have to throw some people out of the boat to keep it from all tipping over, or we're all going to tip over at the same time, and only the strongest that can swim will be able to survive. When or if that comes to the point, I think that's when things turn around. The cattleman can then stick his back up against the wall and say, you know what, if you want these cattle today, they're 130 instead of 120, or that's it. And we have put ourselves in a position that we can begin to resist the bids of the packer. Whether it happens anytime soon or not, I don't know. But the next probably 5 to 6 months, we have to worry about too many cattle on feed. we have to worry about a consumer that is dealing with extensively high beef prices and meat protein prices around all of the different competing protein markets. So that, and I'm not going to go into any of the vegetative alternatives, but we know that they're there and they're growing. Let's just take care of what we've got over the next 5 to 6 months of an issue that we know is in place right now, that being the drought. It's already impacting our input costs greatly. We believe that it could impact the cattle performance in the herd size, move cattle off of pastures early. Anything like that that unfortunately pushes cattle into the production cycle faster instead of keeping them out of it is going to be more detrimental to the market. We should have a good grazing year, and that would keep more cattle out of the feed yards at that time. Unfortunately, this year it looks like a drought, and we may be putting more cattle into it. If we do, even though it'll take longer to facilitate the kill of all those, that is what will bring the end closer sooner. So I'm going to ask that if you have any questions whatsoever, drop me an email. I'll send it out. I will have this recorded and out available sometime between tonight and tomorrow morning. I'd like to thank you very much for taking the time to listen to me. And if you have any questions, please feel free to give me a ring.